Hello everybody, today we'll be looking at Accounting Standards Codification 958-605. So what is this codification? ASC 958 is the overarching principle of accounting for nonprofit organizations. This includes guidelines for financial reporting, revenue recognition, budgeting, but namely we'll be looking at revenue recognition and contribution income specifically. And this is of high importance for nonprofits as contribution income is the main source of income, so to speak, for many nonprofit organizations. For this presentation, I went down the Farhat train, and Professor Farhat talks about 4 different areas in understanding how to account for contribution income, and those are A, regular contributions, B, pledges, C, gifts in kind, and D, exchanges. So the first of these, contributions, is non-reciprocal, meaning that it's kind of like a donation, really. It means that the donor is not expecting anything in return. Secondly, we're looking at pledges, which are much like a promise to make a donation in the future. Again, these are non-reciprocal, making them a form of contribution, but they are a pledge in the fact that they're doing it in the future, so because of that, we defer the transaction until the pledge is fulfilled. Thirdly, gifts in kind, and this is much like a contribution in the sense that it is the same thing, really, but instead of getting cash, we're getting some sort of fixed asset or service out of the contribution. And lastly, exchanges. These are much more like a sale in the way that we understand regular accounting. This is the second major type of revenue source for nonprofits. Now, before we get into our problem, we're going to talk about one more important thing, and that is how donors will put restrictions on the income that they donate. There's 2 ways they can do that. They can either leave them unrestricted or they can temporarily restrict them. When they leave their donations unrestricted, really the organization can use that donation for anything. And because many nonprofits do use a form of fund accounting, just like governments do, we would put those unrestricted funds in something like a general fund. In temporarily restricted funds, we can understand these in the form of a time or a use restriction. A time restriction can mean one of 2 things. Either A, the donor has designated that you not use the funds until a certain date has passed, or B, that this is a pledge and you cannot actually use any of the funds until they're received when the pledge is fulfilled. And a use restriction means that the donor has actually designated what fund or what use he wants his or her money to go to. In this case, it would probably go to something like a capital projects fund, or if they say want this money towards computer equipment, they can designate it to the IT fund. And there's one form of contribution that can use really either of these, unrestricted or temporarily and restricted, and that is a conditional contribution. Conditional contribution means that the donor is not willing to make the donation until the organization has reached some goal or criteria. And we'll take a look at that in the example that we're about to show. So with that, the example that we'll be looking at is what I've done is I've taken Professor Farhat's problem from the FAR exam and I put it in the context of a nonprofit organization, more specifically Forest Springs Camp and Conference Center. This is applicable because we can really see what it's like to use these concepts in a real-world example. And it just so happens that I did my internship with Forest Springs in the accounting office, and much of what I learned was about about accounting for contribution income. And with that, we'll look at conditional contributions. So our first example, Forest Springs has received a notice that it will receive $5 that is not designated to anything specific for every camper that comes to camp in the current summer if the number of campers is over 1,500. That summer, the camp had over 2,000 summer campers. Now, we know this is a conditional contribution because, A, there's a goal that the organization must meet of 1,500 campers. Secondly, it wasn't designated, meaning that it's unrestricted. And lastly, it's non-reciprocal, as it doesn't show anything about how the donor is accepting anything in return. And we account for that as shown here. We'll debit cash $10,000, $5 times the 2,000 campers, and we'll credit contribution income. And something new that you're probably seeing for the first time is this idea of having a class here. The class is what designates the fund that the donation is going into. And because this was unrestricted, we would put this in Forest Springs' general fund. And moving on, we'll look at pledges. So donors have pledged $4 million for the rebuilding of Neil Lodge, which is a main activities and lodging building at Forest Springs. $2 million is received in cash within the first year. $1,500,000 is expected to be received in the next year, and the remaining $500,000 is estimated to be uncollectible. And we can tell this is a pledge because it's a promise to make the donation in the future. It is temporarily restricted, as we know it's for Neil Lodge, which would go into the Capital Projects Fund, and it's non-reciprocal, as they are not expecting anything in return for it. And here's how we account for it. So here we'll debit cash and credit pledge revenue for $2 million. We're putting it here in the Capital Projects Fund. And then for that extra $2 million that we were hoping to receive in the second year, we'll debit pledges receivable, we'll credit pledge revenue for $1,500,000, and we'll credit allowance for uncollectibles for $500,000, as that's what we believe we won't collect. Next, we'll look at gifts in kind. A computer company is donating 5 new desktop computers worth $2,500 fair market value to the Forest Springs IT manager. This is obviously a gift in kind because the company is donating fixed assets, desktop computers. As I said, the asset is being donated, and it is non-reciprocal, as it does not state that the computer company is looking for anything in return. And here's how we account for that. We'll debit computer equipment for $2,500, and we'll credit contribution for $2,500. So all that's changed here is that we changed cash for the other asset that it's actually increasing instead. So lastly, we'll look at exchanges. A donor that lives nearby has pledged $20,000 for the building of Neil Lodge. In exchange, the donor would like to buy 20 acres of unused land that Forest Springs own. And this is an exchange because it is reciprocal. 20 acres is being traded for $20,000, and it is temporarily restricted as it's for the Neil Lodge project. And so here's our transaction. We would debit the cash account for $20,000 and credit the land account for $20,000. Pretty simple. Nothing too complex. And these are the main things that you really need to know about contribution income. And here's a link to Professor Farhad's video if you'd like to look at anything more. And lastly, I'd like to thank you for watching, and I hope you took something away from this presentation.